Welcome to EQD Research Global Insights for Thursday, February 18th. Today, we're going to talk about spot VIX versus the March contract. March is the new front month. Natural gas prices have been rising. Going to check in on the option market there. And tech stocks, strong outperformance over in Asia, still outperforming in the U.S. Starting out in the U.S., the S&P 500 is under a little pressure, down 1%. VIX is up 2.25 to 23.75. March contract up $1 to 26.60. Then we go out farther out on the curve. April to October all have a 29 handle. The March premium is now 285 relative to spot VIX. The average this year has been about $3 for March versus spot VIX. This is mainly due to a couple of VIX spikes that flipped the relationship where the March contract was at a discount for a short period of time. But this time last week, the March VIX was around 26.50 and the spot index was around 21.50. So we are seeing that relationship narrow. Now, when the futures are elevated relative to spot, I'm always looking for a risk-controlled way that people are getting short volatility. Somebody came in today and bought 8,200 of the March 24 puts for $1.92, sold 8,200 of the April 24 puts for $1.69, cost them 23 cents. The goal here is, April will hold up, March will work its way lower, and as it's the front month intends to do, and over time, hopefully they'll be able to unwind that trade at something greater than 23 cents. So it's cold in places that it's normally not cold in the U.S. We're all aware of this. Natural gas, the futures at the highest level since October. The option skew is something I like to look at. Looking at the 30-day 2.5% out of the money puts versus the 2.5% out of the money call options. The out of the money call options are at about a 5% premium relative to the out of the money puts right now. That relationship, the long-term average of that relationship is actually zero. So sometimes the calls are more expensive than puts and vice versa. So I put together a price chart just showing what natural gas futures have been doing lately relative to this relationship between out of the money calls and out of the money puts. And you can see they've both been trending up together. Now, I like to use commodity implied volatility. It's kind of a secondary signal if you're thinking about trading some of these markets. It doesn't behave like stock market implied volatility or individual equity implied volatility. There's more of an anticipatory nature to it, more of an outlook involved in it. Now, right now, natural gas is around 320. The 325 calls are still one of the most active contract, or are the most active contract today. And the implied volatility of calls is still higher than puts. So the concern in the market right now is for higher natural gas prices. But if you start to see the put implied volatility rise relative to the call implied volatility, and combine that with a couple of other indicators, maybe that we're bumping up against resistance or whatever for the natural gas price, it could be a signal that it's time to think about trading a reversal one way or another. And checking in on tech stocks. First in Asia, my favorite new index, the Hang Seng Tech Index, up 25% year to date. The Hang Seng's up 12% year to date, so both of them are having a good year, but that comes on the heels of the Hang Seng Tech Index experiencing strong outperformance last year as well. There are 4 ETFs that give you exposure to the Hang Seng Tech Index. The assets under management has been growing pretty rapidly since they were launched in late August, early September. However, they seem to be petering out in about the $10.5 billion range, so something to keep an eye on. In the U.S., the NASDAQ 100 is up 6.3% year to date versus the S&P 500 up 4.7%. Still a little bit of outperformance there. This is on the heels of a huge year for NDX in 2020. Did come across a slightly bullish trade from yesterday. Late Wednesday with the NASDAQ 100 at 13,700. Somebody sold the February 19th 13,250 puts, bought the 13,050 puts. They did this at a net credit of $2.20. This is basically a day and a half trade because these are AM settled contracts tomorrow morning. Trade does well as long as NDX is above 13,250. I think that gives them a 3.3% buffer. And although the NASDAQ's down a little bit today, and I'm speaking midday Thursday morning, it still looks like this trade is fairly safe for the moment. If we get more weakness, I'll definitely keep an eye on that, maybe tweet out if any action was taken around this trade. Thanks for joining me for EQD Research Global Insights for February 18th. If you like what you heard and found it useful, please hit the like button below and don't forget to subscribe. We also welcome comments and are open to suggestions on how to make this program more useful and informative. Feel free to leave comments below or shoot me an email at rhodes@eqderivatives.com.